What's going on, and welcome back to another episode of The Mortgage Mindset. I'm your host, Trevor Otsuka. I am a licensed mortgage advisor with Barrett Financial Group, and I lend on residential, commercial, and private money for fix and flip. Today, we got a solo show. It is actually Sunday, February 23rd, 2025. We're going to move basically this episode with the newsletter email send out. I'm going to start moving those to Monday morning, get the information to you guys right in the beginning of the week, as opposed to doing it at the end of the week. So we'll see how that goes. So solo show today, we're going to dive right into the market update as far as interest rates go. Here's where we were at on market close on Friday. 30-year conventional fixed is a 6.89% on the rate. 15-year fixed at 6.37%. 30-year jumbo, you're at 7.22% national average. 30-year FHA and 30-year VA are at 6.25%, 6.25%. So we are a little bit improved, right? Almost 20 basis points better, which is 0.2% better than the last newsletter and episode that I sent out to you guys. So we like this. We like seeing a little bit of improvement in the market. And let's get into the reason why. The reason why is because of Friday, we had S&P Global Services PMI for the month of February, which came in a little bit light, a little bit under expectations. So the market had a really nice rebound on Friday, and we saw some pretty good improvement, both in the 10-year Treasury yield and then also on the UMBS or mortgage-backed securities coupons. Both of those are going to have the impact that are going to drive interest rates either lower or higher, depending on how these econ reports are coming out and then how traders are trading bonds and treasuries. So for next week, let's talk about what we got coming down the pike. You got Monday, March 3rd, which is actually, I'm sorry. That's next week. So this week, I apologize about that. We got Tuesday, a couple of Fed speeches, Case-Shiller home prices, FHFA home prices year over year. There's a note auction. Thursday, got a few things. Jobless claims for February. Core CapEx. GDP for Q4 from last year is going to get released. And then on Friday, the biggest item is the core PCE month over month for January. Okay, so we'll keep you posted on that, let you know how these things are going to go, how we're going to be impacted throughout the week. And then this week's news article headline, it's about the job cuts that are happening. So it says, can government job cuts lead to lower mortgage rates for spring? So let's dive into this one right here. Number one, government job losses could drive mortgage rates lower. The potential increase in government layoffs and reduced funding could lead to higher unemployment rates in 2025. Anytime there is higher unemployment rates and the job sector looks like it's softening or it's weakening, you're going to see an improvement typically in the bond market and see interest rates improve. If jobless claims rise, the bond market may react by lowering the 10-year yield, which historically leads to lower mortgage rates. What this means for agents. If mortgage rates decline this spring, buyer activity may increase, creating opportunities to re-engage past clients and first-time homebuyers who have been waiting for better rates. Number two is housing inventory and market activity trends. Inventory is increasing seasonally, but it remains historically low compared to pre-pandemic levels. Weekly pending home sales are slightly lower than last year, but higher than 2023, showing moderate demand despite elevated rates. Agent strategy. So encourage sellers to list now before competition increases in late spring, and buyers to lock in rates early if they expect a drop in the coming months. Price adjustments and home affordability outlook. 33% of active listings saw price reductions last week, an increase from 30% in 2024 and 31% in 2023. Home price appreciation is expected to be only 1.77% in 2025, meaning prices may remain relatively stable or even decrease in some markets. For agents, this is an opportunity to educate buyers on the importance of negotiating price reductions and leveraging seller concessions to make homes more affordable. Home price appreciation to only be 1.77%. I'm wondering if the reason why they are making that prediction is because of the uncertainty of the current administration's economic policies and what they are going to do to all of these inflation metrics. So everybody's just kind of like, let's just make our expectation to be really small property appreciation. So there's a lot of variables here that we don't know. We still going to need some more time to see how these econ policies are really going to affect everything, these tariffs, all that good stuff. So curious to know your thoughts. Super short episode today. Did this in under 7 minutes. I really appreciate you guys. Thank you so much for tuning in. This will be available on YouTube, also on Apple Podcasts and Spotify. If you guys ever need anything, please don't hesitate to reach out, and we will see you guys next week. Peace.